Hey guys, Doug the Retirement Guy here. We got a review of the YMAX Universal Fund of Options. A lot of people hold this that watch our channel. So we want to give you an update. We haven't done one in a little bit of time. Lots changed, lots bounce around. So we really want to cover that. And before we do, we want to thank each and every one of our Patreon supporters. Without you guys, we could not keep this channel alive and doing what we're doing. And then also want to say thank you to all of the new subscribers and all the past subscribers. You guys are phenomenal. You keep making us rocket to new levels and new heights, and we appreciate it. And if any of you want to be a sponsor of the show, go down in the description, hit that Patreon button. It says support the channel. It's simple, it's easy, and you get a lot more information behind the scenes, and we're constantly adding every week. So let's get into today's video on YMAX. Notice to all viewers, past performance does not guarantee future results. The information provided in the video is educational and informational purposes only. It should not be considered financial or investment advice. The examples and suggestions discussed are illustrative and may not be suitable for individual situations. Always consult a licensed financial advisor or professional for making financial decisions. First off, who is YMAX? If anyone's not familiar with this, we'll go over this here. Is the full name is YMAX Universal Fund of Option Income ETFs. The objective is to basically generate income through underlying yield max ETFs, which is typically employed a synthetic cover call strategies, providing income in exchange for capping the upside potential. So what does this mean? They are driven and really focused on creating income each and every week from all of the yield max ETF funds. They do synthetic cover calls over all of those funds. So they're not investing in any one particular stock. It's all in-house. We always call this the fund of funds. And that is they only use the yield max ETFs that are out there. Now, the cap side, this is the one thing that all of these option trading or covered call ETFs do is they actually have a capping on the upside potential. So you will not see YieldMax make huge strides forward. You will not see them, if one particular fund takes off and goes crazy, you're not going to see this one jump 10, 20 points easily. It is going to creep north because it's capped on how fast it can grow. Now, the downside definitely can be a little bit larger because there is no capping on the downside, only on the upside. The performance snapshot offers a high dividend yield of well over 60% annually on a trailing 12-month basis, though much of this may be returned in as a return of capital or RRC rather than income. And that leaves basically a potential of eroding net assets. So the year-to-date return approximately is about 27%, including dividends. So you can see that this thing has dropped a little bit. But because you're making such good dividends, it will still always give you a nice positive return. This launched in January 16th of 2024, so we're well over a full year into this, and we're getting some good information and data from it. And I believe we're going to share that with you today. Considerations and risks of YMAX. Well, the key considerations and risks is this. It's a complex strategy, and it has a limited upside. So again, if someone's looking to put this in and expect growth, you're in the wrong fund. If you're putting into this and again expect this thing to buy at $13 and be 26 in 2 years from now, you're in the wrong program. This is a synthetic covered call approach, which caps that upside potential again, while leaving exposure to that downside risk. So there is a bigger gap of it going down than it has going up. So you start questioning, why is that? And why would we want to be a part of that? Well, that's part of this risk because you're trying to gather income. The distribution risk. Many distributions are return of capital, which can reduce the NAV over time. Okay, so I've done a video on return of capital. It's out there. I'll post it down in the description. So this is putting it in a certain way and reading it one way, when return of capital personally in a lot of ways is a positive thing. because it's a tax advantage for yourself. But we also cover it and explain that return of capital, they can continue keeping a distribution at a certain mark, like 15, 16 cents every single week. Well, if they don't make enough money to cover that 16 cents, they will actually take the NAV, they'll take their value, and they will then issue it as the 16 cents, lowering their NAV rating. We put this in there because YMAX has done that. I'm not going to hide anything. This one, YMAX has done that and actually returns your own dollars and cents. But that is that risk that's out there. The other thing is, combined with the expense ratio and fees, this one is steep on fees. It's 1.28%. Now, I'm not one who always goes crazy about the high fees and look at that. I always look at what's the distribution, what's the return or net gain that we're looking at, and then always that's calculates in with that 1.28%. So we're not going to go crazy over this one, but again, you're over that 1.25% already. Now, new fund risk launched recently, and when I say launched recently, this is things that, like I said, is a year and a half old. It has no long performance history. Long performance history is always 3 to 5 years. So we're still new on this. It's still finding its ground. And as I've done in other videos, I show you that this thing has, it's settling. It's settling down to where it needs to be or wants to be and going forward. And this is a fund of fund structure. So indirect exposure adds complexity. It's in its performance, fees, and transparency. So we love that it's a fund of funds. We love what the performance has done. But it's always, remember, we are on distribution growth, which is income, versus actual value growth. So who might consider this? It's stable for investors seeking high current income. However, its complexity, high fees, downward NAV pressure, and capped upside means it's best approached cautiously and with a full understanding of its mechanics. YMAX offers a high income potential for those prioritizing weekly payouts. If this thing wasn't a weekly payout, I'd probably be sitting there saying, it's not as exciting as it once was. Weekly payouts are huge when it comes to this fund. But you should always be mindful of the following factors. Again, we're going back and repeating a little bit, return of capital, that you could have some erosion over time. You have those high fees that are going to take away some of the additional growth that you've been looking for. And there's a limited to the upside. So really, guys, just remember that this is something, I repeat it again, probably done it 3 screens, but I really just got to put it out there. This is for if you're looking for high income, that you almost want to set it. And I won't say forget it. What you'll be is you're looking to set it, and you're not looking to sell. You're not looking for growth. You're not looking for anything other than income. So let's take a look at the forecast from what we find over the next 3 months, the forecast of YMAX. The technical outlook, which we get this from, is stockinvest.us. Their projected gain is they're looking to have about a 3.25% growth over the next 3 months. So that's basically, I'm going to tell you, is about 1% per month. That's not bad. That'd be a 12% rise if it continued for a full 12 months. So to me, that's a very positive situation. There's a 90% confidence range that you're looking, this thing will land between 1396 and 1493. So that, again, small, slow growth north, positive over the next 3 months. So we're really positive, and they're looking at it too as 90% growth or 90% confidence that there'll be growth over the next 3 months. The short-term moving average shows a sell signal. And when I look into this deeper, I'll explain it a little bit later in the video. I agree with them 100%, while the long-term average indicates a buy signal. Now, this is going to basically give you, and I'll read this final one to you, is suggesting a cautiously bullish outlook if it supports holds. So You just had someone tell you it's a sell, it's a buy, and it's a hold all in one statement. Does that tell you they don't know which way it's going? I'll explain to you in my terms again. Right now, they're telling you everything shows you should be selling this product if you're in the short term. While long-term average, it's time to buy. Okay. And what they're saying is a buy signal if everything continues to hold as we see it today. If we had an August 1st drop off, bad numbers, bad economy numbers or something, you're going to see the value drop off. And that's what they're saying. Whoa, maybe this was the selling point. It didn't hold. But right now they're saying it's a buy signal if you want to be long term, short term, get out. So here's some exciting news that I have. We reported this back when it first broke through. We're going to report it again here. The weekly pay ETFs, the hot news. If you guys all know, YMAX was the first one to come out with a series of weekly paying dividends. YMAX has joined the $1 billion club of assets under management. And as of this video today, they are at $1.15 billion in assets of management with 79.81 billion shares outstanding. Now, why is this so important? Well, this basically tells us, go back to the return on capital. Do they have some room that they can pay back and keep the income growing as accordingly? Yes, it can. But, and we'll show you later on again, is that the AUM has actually been slowly growing. So they're not really getting out there issuing a ton of new shares to just blow this thing up. They're using what they've already established, and they're establishing a very strong foundation. Let's take a look at the YMAX over the past period of time. I put it's on a downward swing. First off, 1 month, it's down 4.64%. 6 months down 21%, and year to date it's down 22%. So this thing has I'll call it, has really have not recovered much from that April 2nd tariff side. It kind of found its new high and new lows flattened out. January of 2nd, start of the year, this thing was at $17.04. In August 8th, today, it's down to $13.14. Now, getting to that $13.96 projected that they're saying is about a 6.24% upswing from this point, which would be a great swing. It's going to take time. It's going to take a lot of effort to get up there. I look at this one right here. When we looked at this in April 2nd, took a huge drop off. We are now just getting almost to that point before the April tariffs kicked in. But that August 1st number, when we had the bad jobs report, it dropped. Not as bad, but it dropped. And it has not recovered. It's actually starting to go down, back down to that level again. So that's a curious and strange point for me, is that this thing didn't recover as fast as it should have. And I'm saying this thing should have been bouncing right back up to where it was playing, which would be closer to that 1340, 1350. I almost want to say that 1370 mark, which would put us closer to that 1396 price point. But this thing is just heading south. So I'm not happy with this. I'm concerned about it. I'll put it. Very serious positioning right now that we need to see some positive growth out of it. The dividend announcement that they've had. And we take a look at this. In July 17th, it came on my radar saying that this thing was down to 10 cents a share. At 10 cents a share, I'd be out of this in a heartbeat if this continued. And we look at the track history in that dividend mark, it's always been above. It's been basically in that 14-cent range on a fairly steady basis with some nice spikes here and there. And that July 17th, 10 cents share. Why do I say I'd be out of it? Because there are so many other funds out there that I could take this money, pour into, and you're going to be the first one to say, well, what about ULTY? ULTY pays at 9.5 to 10 cents pretty much every week, and the fund is almost half the price. So now you understand where I say if I'm only going to get 10 cents from this, I'll double my number of shares and get twice as much dividend over there. When it bounced back up in July 24th to 18 cents, I was like, okay, maybe we just had a little blip in the screen. And then we've been watching it ever since. So that little blip caught us and said, keep an eye on it. And July 31st was 16 cents. August 7th, it'll be 14 cents. And for all of our Patreon supporters, you will see we are now putting in that file the weekly YMAX and the weekly YieldMax dividends with ROC. And those are for all of our paid subscribers first. And then about 4 days later, it'll be open to everybody. But we see those come out realistically on Monday or Tuesday of each week to give you an idea of what's happening into it. So we get some inside information that we can possibly share with you guys about what's happened long before it hits all the big presses. So that's why you want to be a member of Doug the Retirement Guy's package. So here's the thing. The dividend right now, the average is 16 cents. Is that holding? And the answer is, yeah, it's holding. Not just the past 3 weeks, but we take this back for the entire year of 2025. It's holding at 16 cents. Hasn't really been much of a bump in either way. So we're comfortable getting 16 cents, but if we see more 10 centers coming in, we'll be right back reporting to you and saying, hey, maybe it's time to get out and move on. So we'll take a look at the updates. The YMAX Art return on investment. With that 14.5 cents, it's kept us at that 16-cent average at that pricing of $13.14. That gives us an 82-week return, or basically, again, a year and a half return on investment. Fairly strong number. I like that, year and a half. We're right where we want it to be. We're not going to have, we'll be back. Year and a half will be covered if the value of the fund goes down. We will know that we've lost a little bit of our value, but we've collected enough dividends, so we're not in trouble. If it goes up, we're going to smile and be happy with it. But this is why we do these things. This is why we look at the return on investment. How long till we get all our money back from the dividends? Keep an eye on the dividends across the board. So the other thing is YieldMax explicitly states that the YMAX funds distributions may include a return of capital along with ordinary dividends and capital gains. So they do use an ROC, a return of capital. And here's the difference. You look at June 11th, we give you a 96.28% return of capital with 3.72% income. Now, most of that 3.72 is coming from their treasury notes and bonds that they have thrown into all those different funds. But you see the different change that they've now in August, it's down to 55.86% to a 44.14%. We're getting this information now on a regular basis, and we post that in the same report. So why the big difference? Well, income. They've actually shifted more of their funds back to income to take away from their what they call their return of capital. So you're going to pay a little more taxes on the fund coming back versus the return of capital. So the more the dividends continue to make profits and they can do things with the volatility in the marketplace, we expect this to stay about this rate, if not a little bit higher. They are trying to, from what we're finding out, they're trying to get away from that big return of capital to get more balance. And this is a very common that you see as we get closer to the end of the year, so that they can give you a mix across the board. So just giving you an update on this one, that the payments this time are going to be more taxed than before. So if you're not familiar, we'll go over this real quick. What is ROC? And that was return of capital and distributions. Every fund is issued, when they do distributions, they can classify different things as of, is it return of capital, which is basically giving your money back? Is it income that we have ordinary dividends or qualified dividends? So we give you this real quick consideration. If you had a $10 share of an ETF and you bought 100 shares and that ETF paid out $1 a share of distributions at an 80-20 program, return of capital 80%, income 20%, what would that mean to you? Well, 80% of the money would be used to reduce your cost basis on paper. The other 20% comes to you as standard income. Okay. So that 80 cents a share, figuring you bought those 100 shares, basically would be $80 against your investment. So they would be looking at you and saying your investment is now $920 and you don't pay anything on those distributions. Now on that 20 cents, you would pay your regular income tax onto it. So update. The YMAX assets under management, this has been very interesting. When they broke through that $1 billion mark, they really just fluttered at that mark. In May, they dropped down to 1.04 billion. So you can see where they started eating into their assets a little bit, more than likely to pay dividends, keep things going. In July, they bumped it back up to 1.05. And as of August 7th today, the reporting is 1.15 billion. So they were able to increase their assets under management again. And we don't see a huge rocketing number of shares being outstanding. I think they're still at that 79 million shares outstanding. So it's not like they've opened up their floodgates and just issued more stock to generate more assets and that old story. They're actually doing it by managing their assets across the board. So I like that portion of it. I like this as a positive to me. And it's very, very critical that we got to stay above that $1 billion mark, and we got to stay right now. I'd say you got to stay at that $1.1 billion mark to make sure that us investors are happy with what's going on with what you're paying out. So on our eyes, right now, I feel that this is a hold of either side. I'm not a buyer. I'm not a seller of YMAX. I'm on the hold. The AUM of 1.15 billion has made me more comfortable, has made me happier. I'd like to see that number continue to grow throughout the rest of the year without having massive stock reintroduction. I'm not looking for them to say, hey, we're going to have 100 million shares. I don't want to see that. I want to keep that thing at that 79 million shares, and I want to see this to be up to 1.2, 1.3 billion, and I'd be very comfortable having that through. I am positive that this is a 1.5 year return on investment. That means if I bought shares today and a year and a half from now, I'd have all my money back just from the dividends. And if that dividends continue to hold the way that they do, I'm happy with that. Where am I unhappy at is right here. The share price over the last 60 days is down 21.18%. And I really look at it and say, why? Why is it? Is it the volatility is gone? Is something happening in the fund that it's not producing the way I want it to see it? Now, the next kicker to it, which is really stinger, is 4.64% down over the past 30 days. This thing is continuously going down and down and down. So again, I'm not pleased with it. I'm holding my shares. And if you've watched our other videos, I have how we bought our car is related around YMAX. We have a few thousand shares of YMAX in our different investment accounts. So we're concerned in watching this, and that's why I'm on hold. I'm not ready to step in and buy because I just don't see it. And I'm not saying to sell because I believe that the forecast is probably right, that this thing is going to find a turnaround. They're going to find a new path, and they're going to get back up to that $13.96 to $14.93 per share. I'm more on the $13.96 than I am on the $14.93 because I've watched this fund get back up to that $13.70 plus, $13.80 plus, and they did a great job of it, especially if you also take a look at when the dividends were coming down, the price of the shares were going up. And as soon as the dividend starts to increase, we watch the shares go back down. Shares, they're correlated together with that. But to give you my 2 cents onto it, from my knowledge of this, I feel the buy price is actually around $13. So I'm expecting this thing to go down probably in the next 2 weeks. This thing is going to drop again. We're going to be down to that $13 price point. And when we get to that, I'll probably start buying some funds just to do cost averaging to get my costing down, and in waiting for the turn for this thing to start heading north. As long as everything stays the same, we keep getting our 16 cents in dividends, I'll be happy that this thing is down at $13 and buying more, because I'm forecasting to get the $13.96. If something happens with those dividends, this thing would change in a heartbeat, and we'd be saying, get out and let's move into something else. Guys, it's Doug, the Retirement Guy. If you like what we're doing, give us that thumbs up. And if you're not part of the community, hit that subscribe button. Join along with the other 18,000 people that we have. Be happy, be part of the group. You're going to learn something from it. And best of all, you'll be entertained. If you have any comments, leave them down below. Guys, we thank you, and we'll see you next week.